Australia, and I don't mean that in any disrespect. It really is sort of the Sleepy Hollow, but with the massive uranium mines opening up and more exploration, South Australia in growth percentage terms has the most to gain. Perth had it, Darwin's had it. South Australia is going to transform over the next decade from being Sleepy Hollow with a very picturesque cricket ground into being potentially a large mining capital city of Australia. Sort of the growth that's happened in Perth may be what's in store to happen in Adelaide, and if it does, that will obviously be very good for the property market because prices in Adelaide are quite cheap. And then of course there's Darwin. Hard to explain, continues to grow reasonably well, but with these large offshore gas projects happening and limited supply in Darwin, it is likely to continue to outperform the general Australian property market throughout the remainder of 2010. So what does that mean for Melbourne? Well, I think Melbourne's had its growth this year. There may still be some average growth, sort of your 5% to 7% into 2010 or latter 2010. I think Brisbane still has some work to do in terms of oversupply. And I think Perth will probably outperform Melbourne and Brisbane, but I don't think it's going to reach the levels that Sydney will reach and potentially Adelaide and Darwin as well. The next thing to talk about is our domestic economy. And as we look at our domestic economy, what we're trying to gauge is there strength in the domestic economy that is going to lead into people having jobs, people borrowing money, people being happy about going out and buying a plasma TV screen, or is the domestic economy tough and people again are pulling their heads in, not spending money, and that's going to cause economic contraction? If we have a strong domestic economy, people will be happy to borrow more, and as people borrow more, they can pay more for houses. Of course, as people pay more for houses, that means that property prices can go up in value. Well, our domestic economy is doing quite well. As you can see on the screen, it's growing year to March by 2.7%. That's a lot higher than many other countries in the world, particularly the European Union and to some degree the US. Of course, China is growing much faster. India is growing fast, and they have an appetite for our raw materials, in particular our iron ore and coal and those kind of things, and that is why our economy is doing well. It's doing well on the back of, again, a resource-led recovery. Unemployment has fallen unexpectedly from 5.4% to 5.2%. Interestingly, the participation rate, which means the number of people actually participating in employment, was favourable as well, and that means that we have a reasonably strong labour market. If we have a strong labour market, that means that wages will rise as employers compete for a limited number of skilled employees. Wages increase. As wages increase, people can spend more, and that's good for the economy. Obviously, people spending money creates jobs, it creates opportunity. Businesses employ more people because they have higher profits. The government has more money to spend because they're collecting more taxes. That's why we had such great growth in the sort of 2006 to 2007 period, is because on the back of this spending. Of course, we want to make sure our spending isn't debt related. People are actually creating money out of their wages rather than borrowing money and spending it, and that's something that we need to keep our eyes on. If we have people borrowing money and spending it, then yeah, it becomes more of a sugar rush rather than a slow burn. But our economy at the moment isn't growing by 8% or 9%. We don't have a massive inflation problem. And the general story of the Australian economy at the moment is that it's the envy of the world because we're getting reasonably good growth, we have high interest rates, and we are reasonably stable, political issues aside for a moment. Once again, I'll draw your attention to household disposable income. Last year it was a lot higher than this year. And because it was a lot higher last year than this year, it tends to indicate that those people, when they've got higher incomes, are willing to spend it. So growth last year was 11.5%. Growth in household incomes this year are around 5%. And because we're not getting that extra high growth, it means we're still spending, but we're not spending enough to really stimulate into the economy. Once again, the general situation when it comes to the domestic economy is favourable. If we had higher unemployment, if we had the government needing to put out more stimulus, it would be more of an issue. But yeah, so far so good with the domestic economy. Equity markets and the volatility in equity markets is a major concern. As you can see by the graph on the screen in front of you now, it took from between 2003 up to 2008 for the market to go through one up cycle when it peaked at about sort of nearly 7,000 points. but it only took the better part of one and a quarter years to go from 7,000 points back down to sort of around 3,000 points. And that underlines the saying that the bulls climb up the stairs and the bears jump out the window. This volatility that we're seeing at the moment, and I draw your attention to the right-hand side of the screen where we have the most recent data, we have really a 500-point jump and then a 500-point decline happening within a couple of months. And when people are waking up and they're noticing that the share market has gone up by 2% or down by 2%, the Australian dollar's had its biggest ever fall, it's lost 12% of its value and is now climbing back up again. This landscape makes it difficult to make long-lasting investment decisions, particularly business decisions. The lack of certainty means that people are likely to hold off rather than jump in. And until equity markets become less volatile, until we cease reading about the woes of Europe on our daily newspapers, it's hard to see a continued large-scale recovery. This process needs to work itself out. The volatility needs to be resolved. We need a more stable sort of economic position as far as these markets are concerned before lending between banks unfreezes and there's generally more money for people to borrow to invest and take more risks. The message I want you to get out of the volatility in the equity markets as it relates to the property market in Australia is that even though property is not equities, equities are the stock market, the futures, etc., the property market in Australia is not immune to it, and as there is volatility in the equity markets and people park their cash, they're not necessarily going to park it in real estate because real estate isn't particularly liquid. If the stock market was doing well, people would take the profits in the stock market and potentially reinvest or borrow against them to invest into real estate. And when the stock market's not doing well, it's another reason why the property market will tend to be flat in Australia. Whereas if the property market was doing really well and people were happy to invest into the longer term because they felt they had stability and security, then the property market benefits because of that. Let's talk about interest rates now, and you probably don't need me to tell you that there was no movement in interest rates in June. The RBA kept them on hold. The RBA now says that they are at average levels. We'll take a look at that in a second to see whether they are or not actually at average levels. We did have 6 increases in interest rates in 8 months, and because we had those 6 increases in 8 months, that's a reasonably hard slamming on the brakes on the Australian economy. In real terms, the cash rate, the RBA cash rate, as you can see on your screen, went from 3% in April 2009 up to 4.5% in May 2010, an increase of 1.5%. The home loan rate, the bank home loan rate over the same period jumped from 5.75 to 7.4%, which is an increase of 1.65%. That justifies, I guess, the claim that home loan interest rates are going up in excess of the cash rate. Politically, the banks have stopped jumping on it excessively, but they do have this argument that they are somewhat compromised because their cost of funding is going up. Personally, I find that hard to stomach when banks are coming out saying they're making billions of dollars of profit. The real point I want you to get across, or I want to get across to you when it comes to interest rates is twofold. You'll see the graph in front of you right now. I've tried to chart interest rate movements since December 1998 all the way up until current, and I've highlighted for you the recent bottoming and then a recovery in interest rates. Looking at the overall shape of that graph though, I have line of best fit put average interest rates at around the cash rate, that is, at around 5%. And you can see that we're heading towards average levels, but we're certainly not at average levels yet. And that means interest rates could go up sort of 0.5 to 1% more before we're in a situation where they are sort of high or above average. And for those people who are hurting now because their mortgage is high, they ought to expect they're going to hurt some more into latter 2010, 2011. Of course, the caveat here is that if the world economy does tank, the situation in Europe becomes untenable, then the RBA may have to drop interest rates reasonably quickly to make sure that there is continued spending and stimulus into the Australian economy. But everything else being equal, looking at our domestic situation and looking at interest rates, it looks like interest rates have a little bit more to go up yet. As far as an outlook then, the RBA's outlook, you can read it on the screen with me, sorry if it's a bit small, consistent with that outlook and as a result of actions at previous meetings, interest rates to borrowers at around the average levels for the past decade, which is a significant adjustment from the very expansionary settings reached a year ago. Taking all the available information into account, the board views this setting of monetary policy